Hi, I'm Patrick Cannon of Cannon Chambers, and I'm a barrister who specialises in property taxation, including stamp duty and stamp duty land tax. I advise on stamp duty on property purchases, and I also represent taxpayers in inquiries and appeals against HMRC in the tax tribunals and the courts. You can check some of my recent tax tribunal cases in the Notable Cases section of the Cannon Chambers website. Now, this video is about whether or not a property purchase qualifies as mixed use for stamp duty purposes. That's to say, whether the property you are buying consists of both residential and non-residential property, so that the much lower rates of SDLT in Table B for non-residential property will apply instead of the higher rates of tax in Table A for properties that consist entirely of residential property, along with the 3% higher rates for any additional dwelling. If you are buying a mixed-use property, or you have bought a mixed-use property in the last 12 months, it's important to know about this so that you can make sure that you do not pay more stamp duty than necessary. We'll look in detail at the definition of mixed-use property in a moment, but it's quite important to make sure that you don't classify the property you are buying as mixed residential and non-residential if, on inquiry by HMRC, what you regard as non-residential part would actually fail the non-residential tests. HMRC review almost all cases where a dwelling is purchased and it is stated in the tax return or in a refund claim that the property is mixed use. HMRC apply strict tests, which we'll look at in a moment. However, if your property purchase does meet the tests for mixed use, then the good news is that will mean your tax liability is calculated as though the property were wholly non-residential. This means that the 3% higher rates for additional dwellings bought by individuals and the first and subsequent dwelling bought by companies cannot apply. And instead, you can apply the lower rates of stamp duty in what we call Table B, with its top rate of tax of 5% on the slice of the purchase price above £250,000, instead of the much higher rates of stamp duty for residential property in Table A, with a potential top rate of tax of 15%. Just to add that HMRC operate a very confusing policy of initially accepting mixed-use claims or of paying out stamp duty refund claims, but then opening a check into such claims towards the end of the 9-month inquiry period, following the submission of the SDLT return or the making of the refund claim, and then asking for payment of the stamp duty that has been saved or for the refunded amount to be paid back to them if, on review of the property concerned, they disagree that the conditions for the property to be mixed use were satisfied. In these cases, and subject to any appeal against HMRC's decision, you will have to pay the additional tax to HMRC, plus interest, and depending on the facts, a penalty for making a claim that could not be supported on the evidence. If you're thinking of treating your property as mixed use for stamp duty, then do take expert advice and don't just assume that the presence of lots of surplus land not needed to enjoy the dwelling, or an agreement between the seller and, say, a local equestrian or farmer to use some paddocks for horses or cropping, will be enough to make the property mixed use. What are some examples of mixed-use properties? Well, perhaps the most obvious examples are a property consisting of a shop with a flat above, or of a farmhouse and a working farm. However, with commercial or other non-residential use, there will sometimes be no clear dividing line between the residential use of the property and the presence of some form of commercial or other use occurring on the property. Unless the commercial use is clear and distinct, HMRC are likely to challenge a claim for mixed use in this context. You can read some tax tribunal decisions in my notable cases pages where the tax tribunals did not agree that the separate use of part of the property concerned was sufficient to classify the property as mixed use. These cases include Arvidique, Moda and 39 Fitzjohns Avenue Limited. On the other hand, the cases say that to be part of the residential property, the land acquired with the dwelling must be part of the garden or grounds of the dwelling. And here the emphasis is on the word of, meaning that the area of land in question must perform some benefit or function for the dwelling and its occupants, such as providing privacy, a treasured view, protection from development on the boundary, or equestrian or other activities. And you can read a decision where the taxpayer won on this point in my notable cases page by the name of Sutawalla. What qualifies as mixed-use property? Well, most obviously property with a dwelling and also some form of separate commercial use that is clear and run on arm's length lines, such as paddocks let to a neighbouring farmer, a contractor or an equestrian at a commercial rent, or say land leased to a local agricultural college for farming tuition. HMRC will scrutinise commercial arrangements that appear to have been put in place before the time of sale merely in order to create mixed use, and will often challenge such arrangements where the arrangements are not arm's length. HMRC will also refuse to accept as mixed use commercial arrangements that are only put in place after the precise time of sale on the basis that at that precise time there was no separate commercial use. And you can read some tax tribunal decisions about this in my notable cases pages, particularly the cases of Brand Brothers and Kozlowski. What should you be aware of when purchasing mixed-use property? Well, if you're planning to claim mixed use, it's very important to ensure that the property does qualify as such, because you do not want to risk a later challenge from HMRC with the time, trouble and expense that comes with such challenges. To keep HMRC content, any commercial arrangements or activity at the property should be significant and not what lawyers call de minimis, that is, so small as to be ignored. They should be carried on an arm's length commercial basis and evidenced by clear written arrangements, and they should be occurring prior to the sale and not cease as a result of the sale. Problems usually arise with grazing or cropping arrangements with neighbouring farmers which have been entered into on a handshake basis and which are mutually beneficial in the sense that the farmer maintains the land and the fencing, and the landowner is thereby saved the cost of investing in a tractor and mowing equipment and petrol. And in such cases, HMRC will be reluctant to accept that such arrangements are sufficiently commercial to create a mixed-use situation. What legal considerations should investors be aware of when purchasing mixed-use properties? Well, there are a number of legal considerations, and these range from ensuring that any commercial activity or indeed any dwelling at the property has the appropriate planning permission, compliance with environmental legislation, agricultural grants and subsidies, third-party rights, and that the rights and security of tenure of any third-party commercial users of the land are fully understood. What are the tax implications linked to mixed-use properties? The two most obvious tax implications of mixed-use properties are, first, that the tax liabilities relating to the profits and turnover of the commercial activities occurring at the property are properly understood and reported to HMRC, and that the relevant tax is paid. And secondly, that the principal private residence exemption from CGT for the dwelling and its garden and grounds on any future sale of the property is maximised. And here the focus will be on the land required for the reasonable enjoyment of the dwelling, when that exceeds the permitted area of 0.5 of a hectare. The reasonable enjoyment test is the capital gains tax test, and when met, such land will be covered by the exemption from CGT. This is in contrast to the stamp duty test for additional land with a dwelling, to meet the mixed use test, where the garden and grounds treated as part of the residential element of the property is not restricted by reference to what is required to reasonably enjoy the dwelling, but can in principle extend to dozens of acres surrounding the dwelling, even though those acres may be unused and not be included within the capital gains tax exemption. What are the benefits of buying a mixed-use property? Well, the benefit is a stamp duty saving resulting from the property then being liable at the lower non-residential rates at up to only 5%, instead of the higher rates of stamp duty for residential property at rates of up to 17%. What stamp duty for mixed-use properties can be claimed? Well, as mentioned earlier, you can claim the lower non-residential rates of stamp duty for mixed-use properties. Now, how do you seek advice? Well, you can contact me via the contact form on the Canon Chambers website with details of your inquiry, and then I or my clerk will get back to you to take matters forward. When should you get in touch for advice? Well, because of the risk of challenge by HMRC, whenever non-residential rates of stamp duty are paid in relation to the purchase of a dwelling, you should take specialist advice to ensure that if you treat a property purchase as mixed use in your SDLT return or in a refund claim, you had reasonable grounds to do so. Otherwise, you risk a challenge from HMRC, and you may have to repay the stamp duty saved with interest, and there may be penalties applied if HMRC can show that you failed to take reasonable care in deciding to pay the lower rates of stamp duty for non-residential property. Well, thanks for watching, and I hope that this has helped you in deciding whether or not to claim for mixed use. If in any doubt, contact me via the contact form on the website. Goodbye.